I don't want to go into the details of President Biden's 72 points on the power of corporations and the consolidation of corporations and the weakness of labor. You do address it this morning in your note, but I want to go back to an important article you wrote 6 years ago. What kind of jobs have been created? Bill Dudley, how did we get here with declining labor share?
It's not really clear exactly why labor share has declined so much over the last couple decades. Presumably it's because corporations have more power. Antitrust policy has been less aggressive in dealing with anti-competitive practices, and I think labor's power from a unionization perspective is also lessened. But it's also a question of how tight is the labor market. Through much of the last economic expansion, there was an excess supply of labor. We only got close to full employment at the very end of the last economic expansion, then the pandemic hit. So I think the key is going to be, can the Fed drive the economy to full employment? And if the economy is at full employment, then I would expect labor to do better and pick up a bigger share of income.
The primal scream of this document and the political energy that supports it, that supports President Biden, seems to be about a blanket of technology over this generation. Do we underestimate the technological effects on our labor economy, on our American economy?
Well, I think there's no question that the digitalization of the U.S. economy has had pretty powerful effects on the return on capital and the return on labor. I think the ability of people to search now through the labor market and find people to employ is vastly different than it was when people used help wanted advertising to attract workers to employ them.
Bill, there's some belief that maybe Labour has started to get a little bit more power as we work through this reopening. You've written today in your column, is the labour market too loose or is it tight? Is it loose or tight? And Bill, your answer is both. Can you walk me through the thinking, Bill, in your latest piece?
So it's loose in the sense that if you look at the unemployment rate is still elevated compared to where we were in February 2020 when the unemployment rate was 3.5%. Right now it's 5.9%. It's loose when you look at the number of people who are actually employed. We're 7 million jobs short of where we were in February 2020. But if you look at it in terms of how many job openings there are, the number of job openings is at an all-time record. We have 9.2 million of open jobs. Businesses have a lot of jobs to fill. They can't find workers. You actually hear about that anecdotally in the Federal Reserve's Beige Book report, where they talk about how businesses literally can't find workers to hire to do their work. And some businesses actually are cutting back their hours of operation because they can't find enough workers to keep their output up.
So, Bill, when we talk about, though, the power of workers here, when you go back decades prior, there was an argument to be made here that it was the mobility of workers that also gave them a lot of power, and that with the consolidation of industries, with the decline of labor unions, that sort of leverage is just not there the way it used to be. Is it possible to bring that back? Is it possible for that to be done at the behest of government policy?
I think it'll be difficult because mobility has declined. The willingness of people to move from one geographic location in the U.S. to another is much lower today than it was 20, 30 years ago. And part of that's the aging of the population. As people are older, they're more attached to where they've lived historically. So I think it's really about the Fed. It's really about the Fed getting the economy to full employment. If the Fed can get the economy to full employment, make the labor market truly tight, then workers will have to, businesses will have to pay up for workers, and workers will get a bigger share of the pie.
Bill, let's talk about the Fed just briefly. You've talked a lot about the risk, the balance of risks around a Federal Reserve, that once they do lift off, that trajectory won't be as shallow as the trajectory we saw in the previous cycle, a Fed that you were a part of. Do you still feel that way?
Yeah, because they basically said that we're not going to even begin to raise short-term rates until three conditions are met. The economy has to be, at their view, of full employment. We have to hit 2% inflation, and they have to be confident that inflation is going to go above 2% in the future. That's very, very late to actually begin the tightening process in terms of lifting off in terms of short-term interest rates. Before, they used to try to hit, they lifted off early with the idea of hitting 2% inflation, full employment, and a neutral federal funds rate all at the same time. We're not going to do that this time.